welcome everybody. I'm very pleased to be here with you with three exciting speakers, Alexandros, Julien, and Felipe. I will introduce myself very briefly and then we will get to the speakers and deep dive into a very exciting topic from hype to discipline in fintech investment and uncover a little bit what the fintech investment is about today. My name is Anna Fedulov. I'm a tech investor myself. I'm a generalist investor. Fintech is part of my scope, but I'm not an expert as these guys. And I do invest in Europe and beyond in underrepresented founders building impactful solutions. So yeah, we're very, very excited to be here. Let's start off with a quick introduction. It would be great if you could tell us a little bit more about yourself and also your company. Alexandros, would you like to start?
Thank you, Anna. I'm Alexandros. I'm with PayPal Ventures, Series A/B focused, which typically means 3 to 8 million revenue businesses that we help scale to 30, 40, 50 million plus, with a very international focus. So 2 of us out of London doing Europe, Middle East, Africa, Asia, and trying to keep ourselves sane by being very thematically and thesis driven. And with that, over to Julien.
Hi everyone, I'm Julien. I'm leading the fintech team at Spinvest. We are a pan-European fund investing at pre-seed seed. We also have growth. We have an emerging market team, but mainly investing at pre-seed seed all over Europe. Feed over to you.
And I'm Phil. Hi everyone. I run Shapers, which is a fintech-focused fund in Europe, mostly at the early stages. I've been investing in fintech for 12 years now, and super excited about like this transition of fintech from hype to more reality, as I think we're going to talk about.
Absolutely. Maybe before we deep dive into the topic itself, I would be very interested to know what excites you personally as an investor about fintech and why you've chosen basically to invest in fintech versus other sectors.
I'm happy to start. So as I said, like I've been investing for 12 years in fintech. So before fintech was actually a word, and at the beginning it started sort of like with this feeling that it's one of the largest industries globally, not very disrupted yet. Like there's a lot of market cap concentration in a handful of companies, and if you look at the evolution of the last 10 years, it's still broadly the same. There's obviously some very large companies in consumer fintech these days, but there's still so much to build. And I think that when you are in an age where a lot of people stopped chasing the hype and moved on to other industries, we felt that there was like time to double down. Obviously, I think that most investors in fintech have expanded their definition of what fintech is. And obviously, there's huge intersection of like AI and fintech and a bunch of other industries. But for us, like it feels like the next 10 years of fintech are going to be really, really exciting. A little bit more on the B2B side than B2C, but a lot of exciting things to build.
Great. Julien, what excites you?
What excites me, look, we are in the age of era where you can develop all the tools easily with Claude. And what I like about fintech is that we have a moat that is the regulatory moat, right? Like getting licenses, etc. It takes ages, and that's quite nice because when I look at my colleagues from the other teams that are investing in SaaS, health, they wake up in the morning and they don't know if their business is going to, their portfolio company is going to be disrupted by the large Anthropic of this world, right? So I like having the peace of mind of knowing that I have at least 6 to 12 months because my company has a moat with a license. I'm very excited about this. I see a lot of things happening on the tokenization space as well, just rebuilding the whole financial system, but we can discuss this later.
Great. Alexander, so how about you?
Yeah, so I mean, I slipped into fintech about a decade ago when I first joined Portage Ventures, mostly for its team. It was the first fintech specialist platform in kind of Canada, and they've since emerged as a $5 billion manager. But like, I slid into it because all they did was financial services. I didn't know what insurance is and GWP and how you read through an insurance P&L. Same for financial services, reading through a payments P&L. And like I ended up loving it, luckily for me, and kind of stuck through with it for the past decade. And I think financial services, the beauty of it is that expertise does come handy. Like when you try to understand a lending P&L, lending revenues of a very different quality. Insurance premium has a very different quality than a net revenue of a SaaS business. And I think sometimes during hype era cycles, people forgot that. And I think that's part of the beauty of being a specialist. And I think fintech may be very global, but ultimately we've seen champions be born locally. So I think that's the other thing that I'm quite passionate about, like really understanding the local market nuances. Like we've done an analysis, and like I think there's 12 to 15 $1 billion plus revenue businesses in privately held in fintech. Around 9 to 10 are outside the US. So like, there are very big pools of capital and revenue pools outside the US, and I think that's what also excites me about financial services.
Great. So let's deep dive into the topic, hype versus discipline. What is your view on that? Would you agree to this session's title that we are now basically in a phase of discipline after a cycle of hype, or what would you say about that? Julian, would you like to start?
Yeah, so that's a very good question. I think overall we see a lot more discipline. I think across fintech the deal flow has reduced, and people that are building are, they are much more like convinced that they are building something great rather than being opportunistic, because all the founders, a lot of founders, move to AI where it's easy to fundraise. Fintech is less sexy at the moment, but you still have some pockets where it's very sexy. You see crazy valuation. You see we've seen a lot of companies like the AI accounting space raising, and a lot of VCs have poured money into it, and I'm still not convinced that they will go anywhere. We see a lot of other topics like agentic payment that are very hyped across the world. So overall, I think a lot more discipline in fintech, but with still some pockets.
Felipe, what do you think?
Yeah, I would agree. So, I'm not sure we're in a very disciplined era of fintech. It feels like just a very bipolar market where there's a lot of companies that don't get funded at all or almost, and there's some categories called lending or a few other companies that, or a new consumer neobank that is really hard to actually get funded these days, and for good reasons. And then on the other side, you have some companies that are, as Julien was saying, getting so much funding so quickly at really high valuations. And I think if you are in one of those hot topics that is somewhere between AI and fintech, and I think the example of the AI native accounting firms is a great one, where just all over Europe they're getting funded with massive amounts of capital and really quick up rounds. And so there is still a lot of FOMO in the market because there's a lot of capital. The reality is that even if in 2021, 22 we had a peak of the investments in private markets, the reality is that there's still plenty of capital. And as Julien was saying, there's less companies out there fundraising, and so there's more concentration. So capital is more concentrated in few managers, and then those managers are concentrating the capital in fewer companies, and so that's leading to very high valuation rises. And so we as early stage investors have to be very careful with trying to distinguish this hype and FOMO from the companies building the real moats that you were talking about before. And so I'm not sure I completely agree with the disciplined view of the market, but I think it's a bipolar market, I would say.
Yeah, very interesting. Alexandros, what do you think? Hype versus discipline? And
Yeah, I can only echo the words that Julian and Phil have shared. I'd say there's also a nuance by geography, right? In markets like Latin America or Southeast Asia, there was a lot of fintechs being funded by what we sometimes call fintech tourists, so generalists who didn't necessarily appreciate that a lending P&L looks different, right? If you want to generate venture returns in lending, and the path to an exit is that you will be valued a multiple of the book value of your lending book, it's going to look very differently than exiting as a business, as a SaaS business, right? So we saw a lot of that retrench. So in some of these geographies, 2023, 24, you could not get funded as a fintech because, especially Series A+, everyone had gotten kind of burned one way or another, and then they were fintech is this thing. So I think in some of these geographies, it did result in more discipline as a function of that. And in some other geographies that are a bit better funded, discipline sometimes is forgotten. And to Phil's point, sometimes you also wonder, have people forgotten the zero-error learning so quickly? It's like, feels like very nascent memory. So I think it tends to be quite nuanced by sector, geography, and subvertical. But like ultimately, I think great founders who just focus on shipping value, that's what we like to do. And like if you're solving real customer problems, you know, you're primed to capture part of that.
So you all mentioned that there are now fewer but bigger rounds, etc. So there is still some FOMO and hype around certain verticals. In your personal investment approach right now, today, are there verticals or models that you're particularly excited about versus others that you would say these belong to this hype? And where do you see yourself as an investor here? Felipe, would you like to start?
Happy to start. And let's try to disagree a little bit, maybe. So in things that are like really hot right now, I would say like anything that's like AI native is getting sort of like hyped really fast. And that's for good reasons, because sort of like there's a lot of potential value there, but also like the fact that these companies are raising so much money so quickly and so high valuations typically lead not only to less good returns, but also to less discipline in running the businesses. And let's not forget that, as we were hearing in the previous panel, like we now have like so many amazing tools to be able to do so much more with less that you really question like where all of this money is going. The spoiler answer is a lot of that goes to Anthropic and OpenAI, which before used to go into sort of like Facebook and Google. Now there's like more of a shift. So like AI native service, we see a lot of like hype around wealth management. And I think for good reasons, and one of the teases that we have is sort of like that in wealth management, all of us here over the next several years will have sort of like personal bankers in our pockets, like great financial advisors, like tailor-made to what we like to do, and distribution is going to be sort of like the way to get in, not necessarily sort of like the technology as the differentiator. So that would be like two themes that we're quite excited about, so I can mention more. But on the less exciting, I would echo again sort of like lending. I think most venture investors have understood that a lot of these lending businesses are not prone to venture returns. The cost of capital is much higher. Like you need a lot of capital into a very large balance sheet, and you keep getting diluted with like a lot of risk. And so it doesn't feel like the right mode. And I think that at pre-seed and seed, you can still get funded, but then at Series A, Series B, when people are really looking for the scalability, that becomes so much larger. And the other one, making allusion to what Alex was saying on insurance as well, or insurtech, which was like a huge hype in 2020 to 22, backing these MGAs or native carriers that were like going with a better digital experience, supposedly better underwriting, and etc. And then I think like investors realize that gross written premium is not SaaS, that the gross margins are like 15-20% instead of like 80-90%, and they also are quite heavy on capital. So those would be also like two things that we're still looking at it, and we still like to back some of those businesses, but it's getting much harder for them to get funded in this market.
Right.
In the insurance space, we've seen a few plays that are working very well in the US, like Corgi, that have raised like hundreds of millions. So I think there will be a few winners in the space, especially with, I don't know, like new underwriting methods with AI, maybe or like, you know, new sources of data that are available nowadays. So that's a space that we are looking at. And also new distribution channels via the ChatGPT of this world, right? Because a lot of people are, you know, going on ChatGPT on Claude and, you know, asking questions. How, you know, I just moved to Madrid or to Athens. I need a car insurance. And in the future, there will be this new distribution channel where you can just get your insurance directly on this platform. So I think it's opening something interesting. On the overhyped side of things, I think agentic payment is right there. You know, a lot of companies are being funded, but I think that the big players, the Stripes of this world, will just, you know, go for it because it's a massive opportunity. Will be difficult to compete with them. On the underhyped part of things, I think that tokenization and blockchain has a lot of headroom. A lot of founders have dropped this space, and we actually don't see so much in Europe. I think there's a lot more being built in the US, but I think we need to rebuild the whole financial system on chain, and there's a lot to be built. So if you guys are thinking about building the space, feel free to come over and chat to me.
Great. Alex, what do you think? Which models and verticals are worth investing from your perspective, and which are overhyped?
Yeah, we love to run towards friction and markets where you have friction. And we have the luxury, because we have a global mandate, things like cross-border B2B payments are very much solved for in continental Europe, single currency, single banking rails, etc. But then we recently backed a business out of India. Getting capital out as a business out of India, like facilitating trade, that's still a process riddled with friction. Customers are willing to pay for friction. They're willing to pay for having visibility on how long will the transfer take, will it be processed, what are the fees. Similarly, we backed a business that's tackling the US-Mexico cross-border corridor for small businesses. And they have a particular go-to-market motion, but I think what we like to see is markets that have not been disintermediated, in this case, 20,000 FX brokers on both sides of the border, still in 2026, helping SMB businesses. I think these are the types of themes we find interesting, because you're really taking a market that is a couple decades behind. And we're hopefully also, through the go-to-market motion of actually then going after these hundreds of thousands of SMBs, you can build some moat, because for someone else to go after those SMBs, it's going to be a bit more challenging. I think there are some themes like stablecoins, which we're quite excited about, but we think of stablecoin as an additional rail. I don't think of stablecoin as a standalone use case. I would hope that all our cross-border businesses today use stablecoins as an additional rail, because in some markets, some corridors, that's the way to go. So I think sometimes people look at the next shiny thing versus focusing on what's the underlying need and problem that you're solving. Office of the CFO or Treasury Solutions in Europe have had a much tougher time to monetize. In markets like Southeast Asia, much easier, because everyone is used to paying for FX. They're used to paying for transfers in the one and the other. And we've seen businesses, they raise $1 million or $2 million seed, get to 10 million plus in revenue, because they're also used to not getting capital thrown at. So we like the discipline of do more with less, but also solving real customer needs. And again, that global lens, I guess, comes handy in that regard.
Great. Let's move to from basically the big picture and verticals to the company level. And I would like to discuss what you're looking at when you look at a fintech company today. So vision versus fundamentals, so keeping in our topic of today, but what are key things that you are looking at? Julian, would you like to start?
Yeah, maybe I can start, because I do investment at pre-seed seed, so the founder remains the most important thing I look at when I decide to invest. I think the second key thing that I look at nowadays is distribution. Does the founder has an edge in terms of distributing their product compared to the competition? Because for instance, accounting. If I look at accounting, the Xero of this world, they already own the relationship with the founder. They could put a AI wrapper on top of their solution, and it would be good enough, right? Because they have been companies have been working with Xero for a long time, and it's fine. It's not great, but it's fine. So if you are building in accounting, I want to know, what makes you better than Xero? How can you disrupt them, and how do you plan to distribute? So the go-to-market is the key. And then, I want to look at, because going back to what Phil said, it's very difficult to raise at Series A. So sometimes I want to make sure that it's kind of a hype space, how hyped enough where I know that I will be able to raise a Series A, which goes against, this guy is a great founder, I love the space, but is he going to be able to raise a Series A? Not sure. So that's also something that I have to keep in mind, which is not perfect, but yeah.
Yeah, maybe I'll just add to that because I think that's a really important point. In this world where like there's abundant capital in private markets, you would think that it would be really hard to take contrarian bets because like every company is cornered by so many investors. But the reality is like the market is so bipolar as I was describing that actually there's a bunch of companies that look promising at pre-seed or so, but then at Series A, the founders, either because of sort of like the way they tell the story or some of the metrics or the geo or because Anthropic or someone else just came to after their game, like they're just not able to raise. And I think like that, unfortunately, it's on the back of everyone's mind, at least most VCs, when they were doing an investment at pre-seed, seed, or even Series A, it's like, is someone going to fund the next round or not? And it shouldn't, like I think 5 years ago, 10 years ago, there was less of a question because like the market was like broader in terms of dispersion of investors. But now it's really important because of this concentration of capital. And so we really feel that you have to choose of like either you back a founder that you're pretty sure that because of themselves, the market they're in, the company, et cetera, they'll be able to raise the next round, or you have to be very comfortable with the let's go profitable type of journey, which is easier today than 5 years ago because of all of these AI tools and how much you can do with less resources, but it's still not necessarily like the trajectory that most VCs are looking for in terms of like finding a fund returner. So with my fund, with Shapers, we invest typically right after Julien, so at seed Series A. And I would say the founder is still the most important thing. But then after that, like we really have to understand like the space, sort of like how big the opportunity is, sort of like how open it is, and what are the moats, to come back to the first point that Julien was making at the beginning of the panel, like what are the moats against sort of like these frontier labs that are getting more and more verticalized, or versus anyone else actually sort of like building from scratch in an AI native way, or, and like I think you were alluding to this, it's like it's a real competition right now between like the AI native companies trying to build trust and distribution versus the incumbents trying to build like AI native solutions or AI solutions on top of their platforms because they already have the brand, they already have the distribution. And from our conversations with a lot of like the large banks, insurance companies, et cetera, like they would actually rather buy from the current provider because they don't want to onboard like more providers. They don't want to buy from this teeny tiny startup that just started 12 months ago. They'd rather not. But if like that's the best solution that they can find and they trust it enough and it's well funded, they'll do it. And so it's a real race there. And I think like we always obsessed about sort of like thinking, what does this look like in 5 years' time or 10 years' time? And 10 years ago, I think it was much easier to try to visualize the future, even if we're mostly wrong as investors. I think today is like just so difficult.
Yeah.
So difficult.
Yeah, I can only add to that, and I think actually being an investor has become harder than ever because as humans we're primed to think linearly, but the world is going to be changing very dramatically. I think if you were an investor 5 years ago or 10 years ago, you could kind of predict where the world might be at in 3, 4, 5 years. I think the way and the pace that things are changing at the moment is dramatically changing. And like we're seeing it in the ways that we work and that we operate personally, professionally, and all of these different dimensions. But I think that also means and informs what kind of businesses would you want to back, right? Like how do you drive moat, right? Like I think people used to hate regulatory and compliance overhead. Now we joke with our fintech founders, everything they've been complaining about for the last 5 to 10 years, getting regulatory licenses and the one and the other, that's their moat. Because guess what? Like a one-person AI startup will not get a BaFin license very quickly. So I think, you know, regulation, like compliance, solving for that, like having proprietary access to data sets, like verticalized focus. So like you're solving very specific issues. You have like proprietary kind of access that you can leverage and hopefully, you know, continue to build out on that data. Distribution, like, you know, how do you get access to different businesses, right? Like I think SMB-focused businesses where we have backed a vertical SaaS-focused automotive dealer. Well, guess what? To acquire these automotive dealers, someone has to walk to the automotive dealer and convince them to switch over. So for anyone else to come after them, that will take some time. So these are the types of business models that we like to back because we think that they have a reason to also exist in 10 years. I think the other thing is also what's our right to win. It's not just about what does the company bring, but it's also why do we have a right to make a decision on what business in that vertical to back. And if the answer is we don't, then we wouldn't look at it, and the business might be great, but we might just not be the right partner to make the decision and deploy capital in that particular asset.
Great, thanks so much. And we are already coming to the closing of the session. And one last question that I would like to basically hear your perspective about is, if you were a founder today and would start building today, what would you build and why? Felipe, what about you?
So I think, that's obviously an incredibly difficult question. I think it's never been easier to start something and start a company. It's never been harder to actually run a company and actually decide where to go. Because as we were saying, like, it's so hard to now predict what the world looks like in 2, 3, 4 years' time. And when you're building a startup, it should be for the next 10 years or so. So what I can tell you sort of like two of the themes that we're like incredibly excited about. There's a couple more, but I'll go for two, and then hopefully you guys can also disagree with me. But I think on wealth management, we're still seeing, so as I said at the beginning, like at Shapers, we're mostly focused on B2B. And actually there's two specific angles of B2C, so consumer businesses that we're excited about. One is wealth management and the other is crypto. And I would say that wealth management, both B2B and B2C, there's still sort of like so many exciting things to build. And to Alex's point earlier, I think it's also very geo-specific, but in every geo, you can build very, very large businesses, both B2C and B2B. And so that's one we're very excited about, and now I'm like actively looking for folks like at the very early stage there. And the second one would be just on regulation and compliance. Given sort of like what we're talking about of all of these, in the age of AI, there's fraud, KYB issues, AML issues, etc. I think are just going to sort of like explode, and a Cambrian explosion, 100x, 1000x over the next coming years. It already started, and so I think there's like a lot more that you need to build at the intersection of compliance and cybersecurity. And so those are like two themes that we're like particularly excited about, and so I don't think I would start that now, but I would definitely back companies in that space now. All
right, very exciting. Julian, what about you?
Yeah, very good topics, Phil. Well, I think I've been clear. You know, I've mentioned a few times tokenization and blockchain. I think we are moving from a world where we are using bank accounts for, you know, cash, etc. But you have your trading account, you have your real estate, etc. And I think in the future we will just own one wallet, and all the asset classes will be connected to this wallet. So we need to bring all the different asset classes on chain, and I think that's where the future is going. And I think there is still a lot of room to build in this space.
Great. Last but not least, Alex.
Yeah, like, you know, I'm not sure I would necessarily build a venture-backable business. And I think also, by the way, my thesis is that in the future, you might have micropreneurs who have a portfolio of small businesses that just drive revenue, and like you might have like 10 small different businesses. So one idea, which is just born out of having now lived and worked, and I think the latter part worked in 5 different countries, there is still so much friction around setting yourself up personally in a new country, right? Like getting a mortgage, taxation, then, you know, like depending on your setup as an entity or as an individual, and like it's still so conflated. Like it's still so riddled with overhead, and I think it would be awesome, and maybe I should try to do this with my new best friend Claude Opus and Claude Cowork, has a true operating system, right, that gives you an overview. The challenge though becomes, I still think you need that human expertise element, right? Like I iterate a lot with Claude Opus. I still want then a tax advisor or someone to validate that output. And a lot of times it's a lot more nuanced because a lot of the data sets are private, right? Like what's case law? What works, what doesn't work? It's one thing how the theory was written out, it's another thing how it's lived and practiced. So I think that for me is quite interesting, right? Because you can have a technological layer and foundation, but then that human expertise on top. And again, I don't know if that would be a venture-backable business to build a 10 billion plus company, but I do think that the TAM is meaningful enough with so many expats. Both Phil and I live now in Portugal, and we've both lived in different markets. Julian is French, lives in the UK. Same with you, between 2 countries. I think the TAM could actually be pretty meaningful to build something like this. And selfishly, it would solve a big friction of personal admin in my life.
All right, thanks so much. So Thanks for listening. We are coming to the end, and thanks to the speakers for sharing all these exciting perspectives on fintech today. Thank you.
Thank you.
Thank you.